What's up everyone, it's Caddy with Money Vesting. So in this video, we are going to be talking about Silicon Valley Bank. I've got some more updates and a much better simplified video that will help you really understand what is going on and what is going to happen with this situation. We're still all waiting on more updates and to see how this all plays out. But hopefully this video gets you up to speed and what is really going on with three parties that are going to be affected the most. So we are going to be focusing on those individual parties, and I will be explaining the situation right now. As always, if you guys enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, we have launched a brand new channel called Money Vesting Minutes. So we're going to be doing our conversations and discussions and interviews with a lot of our upcoming guests, and will be posted on that channel as well. So make sure that you do check that out as well, and make sure to subscribe to that channel as well. So first things first, I want to be very clear and share my opinion. And I do personally believe that this event that we're seeing with Silicon Valley Bank is not comparable to what we saw back in 07 and 08. It is more contained. And the more that I've learned about this, the more research I've done, it is very clear that this is not at the same scale or size as what we saw back in 2007, 2008. I do believe that this definitely will have some ripple impacts. But when you talk about some of the larger banks, when you talk about some of the bigger banks such as JP Morgan, Bank of America, some of the well-known national, international larger banks, they are well capitalized with a lot of liquidity. Are they holding on to some losses? Sure, they are, right? Their bond portfolios are not doing super great because bond prices are coming down as yields are moving higher, but they're still well capitalized and very liquidated. So in other words, I don't personally believe or think that this is going to be at the same scale as 0708, but definitely does have its own place with the fallout that we're seeing in Silicon Valley Bank. So $90 billion have so far for a select group of banks have been wiped out in market cap over the last 48 hours since March 8th to March 10th, since there's been a significant sell-off. And I've broken it down into these three parts. So SVB, this is the Silicon Valley Bank here, and what happened pretty much affected three different parties, right? So first one's going to be customers. So customers are actual people or actual businesses who bank with the Silicon Valley Bank or had their cash in the company, right? Since it is a company, it is a bank that pretty much finances and is there for tech startups and private equity, right? So it's very much focused on that particular sector. Obviously, you'll have a lot of companies that were holding money, holding cash, or having deposits in their bank. They're certainly affected. The second type of people, of course, investors who were either directly or indirectly invested in Silicon Valley Bank. So they're obviously getting affected by this entire debacle as well, and the mess that Silicon Valley Bank has created. And third, we've got banks, and this is other banks, regional banks, and other financial institutions that are in a very similar situation like Silicon Valley Bank, because right now we're only just focusing on Silicon Valley Bank, but there's another one that is actually in a very similar situation, which is Ally Bank. They also have a pretty substantial amount of losses they're holding on to, much more than a Silicon Valley Bank, which we're also going to talk about. So let's just dive right into it. First things first, let's just talk a little bit about investors, because they are going to be the first ones, to obviously go out, and it's going to be very easy for us to quickly analyze. So when it comes to investors, investors who are directly or indirectly investing in SIVB. So if you take a look at where the prices were, cost basis for SIVB investors as of January 31st, literally about a month and a half ago, we had over 90% of all shares profitable for SIVB. That's a pretty substantial amount if you think about it, right? 90% of all investors in this company were profitable, right? With an average cost basis sitting at $256 per share. Pretty substantial. Fast forward to March 10th, and this is where we are, only 0.85%, less than 1% of investors currently profitable on this position or on this stock, and the average cost has dropped from $250 something, $256 down to $138 per share. So even though investors have seen this as a buying opportunity and have bought back, lots of investors, pretty much over 99% of investors are holding on to losses, unfortunately. And as a result, we are seeing most of them kind of wiped out at this point because of the significant sell-off. And this is not even fully accounting for the fact that pre-market, this stock was trading as low as $39 or close to $40. It was down another 60%. The last closing price that they have accounted for is $106, which was on March 9th. So March 10th, there was no trading because it was halted and FDIC pretty much stepped in. Now, talking about companies that actually bank with SVB or have had, some cash in their bank or deposits in their bank, or have had previous partnerships and banking structures with this company. So again, we're now moving away from investors over to customers of Silicon Valley Bank. And we learned that officially Roku has about $487 million in the cash at failed Silicon Valley Bank, and Roblox and Vimeo also say they had accounts. None of the companies say the bank's failure will impact operations. Of course, they say that to make sure that nobody panics and nobody actually starts, start leaving the company or having some bank runs. They're definitely saying that to make sure that everyone feels secure. But we've got Roblox, we got Vimeo, we got Roku, and then some of the other companies. Upon my research, again, these are not confirmed reports. Like, we have not directly heard from those companies, or Silicon Valley has not mentioned this. But this is simply based on the research that I've done, maybe something from the past. I do believe that a lot of startups had cash in Silicon Valley Bank, considering that they pretty much funded over 50% of startups in Silicon Valley. And you can think of companies like, I'm not saying these are the companies that bank with Silicon Valley, but you can think of companies like Instacart, we got Vimeo already, of course, we got Zoom, we got Palantir, we got Uber, we got Pinterest. There's a lot of companies that are in Silicon Valley, pre-revenue, pre-profitability startups and tech-oriented that may or may not have banked with Silicon Valley. So those are obviously going to get affected. And if you take a look at some of the reports that have been coming out, as a panic spread and the FDIC stepped in, companies with funds locked up were reporting problems getting cash out and making payroll. That's a pretty big problem, right? That's exactly one of the reasons why companies tell their employees that it's not going to affect operations, because it's gonna obviously create some panic, and if they struggle making payroll, that's not good. So one startup founder told CNBC that everyone is scrambling. He said he talked to more than 30 other founders, and that both big and small companies are being affected. So there you go, 30 other founders right there, and they're all getting affected. And the founder added that a CFO from a unicorn startup has tried to move more than $45 million out of Silicon Valley Bank, but no avail. And another company with 250 employees told the founder that Silicon Valley Bank has, quote, all our cash. So these are customers that are being affected from what's going on in Silicon Valley. And this was something that was posted by Genevieve, and venture funded. So we bank nearly half of all U.S. venture-backed startups and 44% of U.S. venture-backed technology and healthcare companies that went public in 2022 are SVB clients. So that, again, is a pretty substantial number. And if you take a look at what Genevieve wrote, Silicon Valley Bank has 50% of all U.S. VC-backed startups and customers, and there are over 130,000 VC-backed companies according to PitchBook. That's nearly 65,000 if you take the half of 130,000 startups that used Silicon Valley Bank. So this is certainly a big problem, but again, just kind of clarifying, I personally don't believe it's going to be at the same scale of what we saw back in 07-08 at the housing market, because some of the largest banks right now are still well capitalized, and we'll get to the banks here in just a minute. But right now we're talking about customers. This is going to be more directed towards customers of Silicon Valley Bank. So if Silicon Valley Bank is not able to pay back on its deposits, right? Because again, FDIC insures you up to 250,000. So beyond 250,000 obviously becomes a bit of a problem for Silicon Valley Bank, because FDIC insurance kind of runs out. And what this tells you, this chart, is pretty much deposits that are less than 250,000 as a percentage of total deposits, right? So what we're seeing here is fourth quarter 2022, and you can kind of take a look at each and every bank. I just want to make sure that we are recording here. Let me just go back. Just want to make sure. Boom, boom, boom. All right, check. Perfect. So this right here at the 99 spot, we've got Silicon Valley Bank Financial Group, so SVB, and you can see that that number in the fourth quarter of 2022 was at 2.7%. What does that tell us? That tells us that over 97% of deposits that Silicon Valley Bank has have an account balance of over $250,000. So deposits less than 250,000 as a percentage of total deposits, only 2.7%. So over 97% deposits are more than 250,000 as a percentage of total deposits, which are not insured by FDIC, because FDIC obviously still only insures up to 250,000. And later on Friday, one of the startup investors called Yang and offered to help Akita make payroll. And she said, quote, "My hope is that the government bails out people past 250,000. I know people with tens of millions of hundreds of millions of dollars with the Silicon Valley Bank. I think if they only get 250,000, their companies are going to absolutely get wiped out." So a government bailout is definitely on the cards here because it is a very, very large bank. And now everyone's waiting to see when the Treasury will step in. Hopefully, California Governor Gavin Newsom is calling Biden right now and saying that this is a systemic risk in our area. But you can see the ripple effects on other banks and their equities and their bonds. If it's systemic, I think the Treasury will step in like 0708 and protect the money market accounts, plus will protect the depositor as well, depositor being the companies that actually do bank with Silicon Valley Bank. If they don't step in, then people will presume that money is lost, and that's going to have a huge ramifications on the business environment. You could see a lot of bankruptcies. You could see a lot of companies going under because of lack of liquidity and pretty much not having the cash to make payroll, not having the cash to pretty much make investments, and not having the cash to run their businesses. So now that we've covered customers, we covered investors, we covered customers, now we move over to banks, other regional banks, and other sort of institutions that could be in a very similar situation. So this report suggested that nearly all banks are sitting on unrealized losses in their bond portfolios. SVB is the bank most likely to have been put in a position to having to stock up on bonds at their peak price. It is probably not the only one struggling with the whiplash in prices. Janet Yellen, the Treasury Secretary, says she's monitoring several banks in light of the events in Silicon Valley. Thankfully, the loan books make up a much larger share of assets at most other institutions, and with the rates rising, they're earning more. So here's the difference. Silicon Valley Bank and other banks, they're most likely most of them are sitting on losses on their bond portfolio, as I mentioned earlier. And the reason is because mortgage rates are pushing higher, US treasuries have been pushing higher in terms of yields, and prices are coming down because of that inverse correlation. And as prices come down, of course, they take a hit on a more market basis, right? If you were to kind of have that market pricing, their bonds are worth less than when they purchase them. But the idea is they're going to be holding them till maturity. And the only way they can hold till maturity is if their depositors don't need the cash immediately, right? With SVB, what happened was obviously they as interest rates went up, cost of borrowing went up, and valuations came down, crashing down, in fact, in 2022. And as depositors start to kind of take money out all at the same time, and there's a bank run on SVB, they have to pretty much sell. They're forced to sell their bond portfolio at a loss, at close to $1.9 billion, to make room, make liquidity for their depositors and make sure the cash is available for their withdrawal, for the payroll that they need to make, whatever the reasons might be for them to spend the money, it's available. With some of the larger banks, their loan volumes are very good. They are able to lend the money. The net interest margins are very, very high. And even Silicon Valley Bank's yield, right? So net interest margin is actually really low compared to some of the other banks. So it's mostly a management/liquidity issue as opposed to anything else. And 20 banks that are sitting on huge potential security losses, as was Silicon Valley Bank. So right now you'll notice that this right here are some of the banks that are sitting on very similar losses. And right now you'll notice that Silicon Valley Bank Financial Group sits right here, $1.9 billion. And this is a 10.5% of their total equity capital available of about $18 billion, right? So you kind of take that $16.2 billion, you add back the market value without the loss, and then that's $1.9 billion in losses with respect to their total equity capital available, and that's 10.5%. And then if you take a look at Ally Bank out of Detroit, they're sitting on over $4 billion, which is about 24% of their total equity capital. So that is also a potential bank here that you may want to keep a close eye if you are invested in Ally Bank. If you are, if you have money in Ally Bank, you definitely want to be careful here, considering that they are also sitting on pretty substantial amount of security losses, and of course, 24% of total equity capital. Some of the other banks will include New York Community Bank Corp, Sandy Spring Bank Corp, First Republic Bank. My uncle has an account in that bank, a very, very small 1.9% only, and $331 million, but still you definitely want to keep a close eye and don't want to have that number increase as a portion of the total equity capital. So definitely be careful with that as well. And these are some of the banks with the highest percentages in terms of the losses with respect to the total equity capital. This is in terms of dollar, I believe, or the top 20, and then you can see the top 20 over here as well in terms of the percentage of their total equity capital. So the biggest one is Comerica, CMA, at $3.7 billion loss right now and 42% of their total equity capital. And you can see what happened to CMA over here. So you can see that they pretty much dropped aggressively here. On Friday, they were down 5%. On the day before, they were down 8%. So all in all, they pretty much sold off a little bit over 12%. Not as aggressive as Silicon Valley Bank, but definitely worth mentioning and definitely something to pay attention to. This right here is a spreadsheet. I've kind of put those together, and again, I've not included all the banks, but I want to talk about the some of the larger banks here. So Deutsche Bank and some of the other ones. Again, they're well capitalized, much more liquid, and a lot more assets compared to some of the other regional banks and smaller banks. So all in all, I mean, some of these ones that I've kind of put together a list for. Again, this is not an exhaustive list, but they have pretty much lost close to $90 billion in market cap in the last 2 days alone. And of course, SIVB losing over 85%, market cap on March 8th being $6 billion, and now it's come down to now under $1 billion, sitting at $850 million if you account for the Friday's loss, which obviously there was no trading on Friday because FDIC stepped in and halted the price, but market cap loss sitting at close to $5 billion, along with the $1.9 billion that they lost selling their portfolio. So we're in a very, very interesting sort of time here where we need to be careful. We definitely need to be vigilant and pay attention to what's going on in the banking sector. If you are, either banking with these companies or invested in these companies, or definitely have some exposure in some way, some form or another, you definitely want to be on top of it and make sure that you understand the risks related, because even banks are not safe. I mean, Elon Musk posted a meme talking about invest in banks, or put your money in banks because crypto is a scam, and then put your money in crypto because banks are a scam. It's just kind of like, the person in a dilemma and what to do, right? So hopefully this gives you a little bit more insight. Let me know your thoughts down in the comment section below. As always, if you enjoyed this video, find it helpful, make sure that you drop a like, subscribe to the channel, and happy investing, and I'll see you all in the next video.